Welcome to Balance of Economy. Before we dive into the data, please note that this is market research for educational and informational purposes only and does not constitute financial advice or recommendation to buy or sell any asset. Let's look at the numbers.
So picture this. You have a legacy American automaker bleeding billions of dollars on electric cars, right?
Right.
And suddenly they decide that their absolute best lifeline is to start building giant batteries to keep artificial intelligence from, blacking out the entire power grid.
Which is wild, but welcome to your custom deep dive. Today we're really trying to cut through the noise of this April 2026 market panic.
Exactly.
Because we need to answer the single most important question for you right now, which is, are we watching the AI bubble finally burst, or is the market just overreacting to a massive macroeconomic pothole?
Yeah, and if you just glance at the headlines right now, the sky is absolutely falling.
Oh, it's red across the board.
Completely red. But before we get into the tech stack and look at the actual companies, we really have to establish the macro environment. Because that is the gravity pulling everything down right now.
Yeah, that's the context we need. So break down what's actually driving this.
Well, the broader market is gripped by a severe risk-off movement. Institutions are just pulling back everywhere. And it's driven by this really toxic cocktail of worries.
Okay, what's in the cocktail?
The primary catalyst is an energy supply shock. It's centered around the Strait of Hormuz.
Right.
And when that kind of disruption hits, it instantly reignites fears of persistent, sticky inflation.
Because energy costs feed into literally everything. I mean, the manufacturing, the shipping of everything else. If oil spikes, everything's stuck.
Exactly, which leads directly to the second part of the cocktail, which is the leadership uncertainty at the Federal Reserve.
Right, the Fed.
Yeah. When institutional investors see energy prices spiking, and they don't know who is calling the shots at the central bank or, what the next rate move will be.
They panic.
They panic. They need to reduce the overall risk in their portfolios immediately. And unfortunately for the tech sector, high-growth AI stocks are the most liquid, profitable assets they have on hand.
So they're the first thing sold.
Exactly. They get liquidated to raise cash.
This feels like a moment where we need to separate the engine from the chassis.
I like that.
Like, are we looking at an AI engine that's finally blowing up after running way too hot? Or did the broader economy just hit a massive pothole? The car was speeding along, the axle snapped because of inflation and the Fed fears. But the engine itself, the AI fundamentals, might actually be perfectly fine.
And that distinction is the entire mission of our analysis today. We really have to separate narrative from the numbers.
Right.
Because the market is currently trapped in what we call a panic trap.
Mm-hmm.
To quantify that, if you look at the Fear and Greed Index, it has plummeted to 13.
13 out of 100. I mean, for the listener, that is deep, deep into extreme fear territory.
Absolute extreme fear. And the thing is, at a level of 13, selling becomes entirely indiscriminate.
Meaning they aren't looking at the actual businesses.
Not at all.
Yeah.
A portfolio manager isn't looking at an AI company and saying, their business model is broken. They are saying, I need to raise cash today. This AI stock is up 50% from last year. Sell it.
Wow.
Yeah. And that dynamic creates massive price dislocations, meaning the stock's current price tag has completely detached from the actual cash the underlying business is generating.
It's basically like selling your winning lottery ticket at a 20% discount just because you desperately need cash to fix a flat tire on the way to the bank.
That is a perfect way to frame it. The
Yeah.
fundamental value is absolutely still there, but the immediate liquidity need is overriding logic.
Right.
The market has technically, hit a wall after a massive parabolic run. A breather was inevitable. But the business realities, the fundamentals, they tell a completely different story.
Because we're not talking about pets.com here.
Exactly. We are not looking at empty shell companies like we saw in the dot-com bubble. Corporate data shows massive, tangible revenue. I mean, Microsoft is still posting real revenue growth of 17%.
17% growth at scale is insane.
It is. And Apple is right alongside them with 16% growth.
So we have these high-quality assets generating massive growth, getting dumped simply because funds need to lower their risk profile.
Yeah.
So if you're a listener trying to find the signal in all this noise, where do you even look?
Well, you look past the current quarter, right? And you find where the physical bottlenecks of the AI boom exist. because that is where the fundamental strength actually lives.
Okay, the bottlenecks.
Yeah. And the first undeniable bottleneck is where the data is actually stored.
The physical storage layer, right?
Right.
The pick and shovel infrastructure of this whole gold rush.
Exactly.
Because I'm looking at notes here from Morgan Stanley analyst Eric Woodring, and he just elevated Seagate technology to top pick status over Western Digital. And the market reaction here compared to the underlying business model is just wild.
It is. I mean, Seagate stock recently jumped about 6% compared to Western Digital's 3.6%. But even factoring in that bump, Seagate continues to trade at a discount.
So it's still cheap.
Still cheap. And Woodring's thesis is that Seagate is positioned to expand its gross margins much faster over the next 12 months, mostly due to a more robust offering that's perfectly tailored for the current environment.
Wait, let me pause right there. Why are hard disk drives, like HDDs, suddenly the bottleneck?
It sounds counterintuitive.
It does, because for years the narrative was that everything was moving to flash memory,
Yeah.
solid-state drives. Why are these spinning magnetic disks from the 2000s the linchpin of artificial intelligence?
It really comes down to scale and cost per terabyte. Woodring notes that HDDs still store about 80% of the world's cloud data.
80%.
80%. Because when you are training a massive language model, you are scraping and storing unprecedented oceans of text, images, and video.
Just staggering amounts of data.
Right. And you don't need all that data instantly accessible on super expensive flash memory every single second. You need massive, dense, cost-effective cold storage.
Cold storage.
Yeah. Data centers now represent over 80% of the entire HDD revenue opportunity. You simply cannot physically build out an AI ecosystem without miles and miles of hard drives.
But usually when demand for a hardware component skyrockets like that, the companies making them just, spin up 5 new factories and flood the market.
And that is the crucial detail here. They aren't doing that.
Really?
No. The HDD manufacturers are demonstrating ruthless capital discipline right now. Woodring pointed out they are absolutely refusing to add any new greenfield capacity.
Okay, greenfield capacity meaning entirely new manufacturing facilities built from the ground up on like an empty greenfield.
Right, exactly. They aren't building them. The HDD industry learned some incredibly hard lessons from the brutal boom and bust oversupply cycles of the last decade.
Oh, because they overbuilt in the past.
They overbuilt, prices crashed, and it was just an absolute bloodbath. Today, it's an oligopoly.
It's just a few players.
There are only 3 players left in the entire HDD market, and just 2 of them, Seagate and Western Digital. They control 90% of the entire market.
That is wild. So we basically have a gold rush for data, but the only 2 landlords in town are refusing to build new apartment buildings.
Perfect analogy.
They're perfectly happy to just let demand far outstrip supply, sit back, and exercise maximum pricing power.
Precisely. And Woodring estimates that because of this discipline, supply and demand won't actually reach parity until 2029.
2029, that's years away.
Right. That is a full 12 months longer than his original projection. It creates an incredibly favorable environment for long-term margin expansion.
So they are in total control.
Total control. Unlike memory chip companies that are currently facing, oversupply risks, the HDD landlords are sitting pretty.
Okay, so having the storage space secured is one thing, but turning all those drives on requires power. I mean, data centers are massive energy hogs, which brings us to the infrastructure pivot that genuinely shocked me. You mentioned it at the very top of the show.
The Ford pivot.
Yes.
Yeah, the power constraint is becoming so extreme, it is literally reshaping legacy American supply chains.
Right. Let's give the listener some context on Ford. Late last year, so December 2025, they faced a brutal reality check. Ford had to take a massive $19.5 billion write-down.
Staggering number.
Staggering. They basically conceded that their aggressive, multi-billion-dollar electric vehicle strategy was bleeding the company dry. I mean, the EV segment by itself lost $4.8 billion in 2025 alone.
It was a painful admission of misallocated capital.
Yep.
But their next move demonstrates just how pervasive the demand for AI infrastructure really is.
Right, the pivot.
Yeah. So Ford is taking a massive plant in Kentucky and pouring a fresh $2 billion investment into it.
Okay.
But no cars will roll off that assembly line. They're completely repurposing it to build BESS. That's battery energy storage systems.
Wait.
Yeah, specifically designed for data centers.
I have to push back here Because on the surface, a legacy automaker suddenly pivoting to data center batteries, it sounds like total desperation.
I know how it sounds.
Like, is Ford actually an AI infrastructure play now, or are they just scrambling, throwing darts at a board to recoup those devastating EV losses?
I get the skepticism, but when you understand the sheer magnitude of the power bottleneck, the pivot is highly rational.
Really?
Yeah, electricity is the primary ceiling on AI expansion right now. You can't just plug a hyperscale data center into the local municipal grid.
It would probably melt the grid.
It would. Expanding traditional power grids, building new substations, routing new transmission lines, that involves years of regulatory red tape and environmental reviews.
Which they don't have time for.
Exactly. Hyperscalers cannot wait 5 years for a permit to power their servers.
So they are bypassing the grid entirely.
They are forced to. They are installing massive on-site power generation and relying on these battery energy storage systems to manage the load.
So basically giant backup batteries.
Giant batteries. If the grid hiccups or if compute demand suddenly spikes, those batteries ensure the data center doesn't go dark. Ford is just leveraging its existing battery manufacturing expertise. They're just pivoting the end customer from a driver to a server farm.
Wow. What kind of scale are we talking about for that Kentucky plant?
They are targeting an annual production rate of 20 gigawatt hours of batteries by late 2027.
That's huge.
It is. And to your point about whether an industrial legacy company can actually successfully pivot into AI infrastructure, look at Caterpillar's recent trajectory.
The tractor company?
Yep. Caterpillar leaned heavily into on-site power generation for these exact industrial needs, and it transformed their power and energy division into their largest business segment.
Wait, really? Their largest segment?
Their largest. And Ford is looking at a global BES market that's projected to hit $106 billion by 2030,
Wow.
growing at almost 16% a year.
The ripple effects are just staggering. I mean, the AI supercycle is literally funding the revitalization of an American automotive plant.
Exactly.
All right, so we've secured the Seagate hard drives, we've got the Ford batteries keeping the lights on.
Yep.
Now we have to move to the processing core, right, the compute layer. This is the heavyweight bout between Advanced Micro Devices and Intel.
It really is about. Both are fighting desperately to capture this next wave of AI data center compute. But the fourth quarter 2025 data paints starkly contrasting pictures.
Because AMD's numbers are frankly ridiculous. Total revenue in Q4 was up 34% year over year to a record $10.3 billion.
Yeah, and drilling into that specific $10.3 billion, their data center revenue specifically surged 39% to $5.4 billion.
Insane growth.
That growth is powered by massive enterprise adoption of their EPYC server processors, alongside the continued ramp of their Instinct GPUs. And crucially, they aren't just selling a lot of chips, they are incredibly profitable.
Right, because revenue is one thing, but profit is another.
Exactly. They printed a record $2.1 billion in free cash flow in a single quarter, and their balance sheet shows $10.6 billion in cash.
Okay, let me play devil's advocate for the listener, though, someone who's trying to spot a bargain in this current market sell-off.
Sure.
If I pull up the valuation metrics right now, Intel is trading at roughly 4 times sales, while AMD is trading at a premium of 10 times sales.
Right.
Doesn't that make Intel the classic value play here? I mean, it's so much cheaper.
It does seem that way, but that assumes cheaper is always better, which ignores the concept of a value trap.
A value trap.
Right. In a macro-driven panic like we're in now, cheap is absolutely not synonymous with safe.
Okay, explain that.
You have to evaluate the underlying mechanics of what you are actually purchasing. Intel's Q4 data center and AI segment did show 9% growth, yes. But their overall total revenue actually contracted by 4%, dropping to $13.7 billion.
Meaning their legacy PC and consumer businesses are basically an anchor dragging down whatever AI gains they make.
Exactly. And the anchor is incredibly heavy. I mean, the most alarming metric from Intel is in their foundry segment.
The actual physical fabrication plants where the chips are manufactured.
Right. That segment posted a jaw-dropping $10.3 billion operating loss in 2025.
$10 billion lost just trying to manufacture the chips.
Yes.
For the listener who isn't deep into semiconductor mechanics, why is a foundry such a massive financial black hole compared to simply designing chips like AMD does?
Because semiconductor fabrication is arguably the most complex manufacturing process on Earth. You are dealing with extreme ultraviolet lithography machines that cost hundreds of millions of dollars each, housed in clean rooms that require billions in capital expenditure just to build.
Just to build the room.
Exactly. And Intel is attempting this historic high-wire turnaround. They have to fix their manufacturing yields, upgrade their fab technology, launch next-generation products, and try to expand profit margins all at the exact same time.
That sounds nearly impossible. While AMD, which outsources its manufacturing, is already printing billions in free cash flow and dominating the specific CPU segments where data center demand is highest.
Right. AMD offers fundamentally lower risk exposure to the proven existing demand of the AI supercycle. Intel's turnaround might eventually work, but it requires near-perfect execution over years.
Yeah.
AMD is already successfully executing today.
Got it. Okay, so we've built the data center infrastructure, we powered it with Ford, filled it with Seagate, ran it on AMD.
Now we need the software.
Let's look at the software layer that's actually paying for all of this hardware. We need to talk about Alphabet, because this seems like the purest example of the panic trap mispricing reality.
Alphabet is the ultimate case study for our core question today.
Yeah.
The stock is down 7% year-to-date. The macro fears regarding inflation and ad spend pullbacks have just hammered them.
Right.
But the actual Q4 results showed total revenue rising 18%.
Wait, but consumer search is one thing. If enterprise budgets are freezing up because of macro panic, surely Google Cloud is seeing a massive pullback, right?
You would think so, but the opposite is actually true. Google Cloud skyrocketed 48% year-over-year.
48%.
Yeah. And even more telling than the revenue is the backlog they announced. A staggering $240 billion.
Let's underline that for a second. $240 billion.
It's a massive number.
Because that isn't a vague projection of future trends. That is locked-in, contracted enterprise demand.
Exactly.
Companies have actually signed on the dotted line for that compute. It makes perfect sense why billionaire Ken Griffin currently ranks Alphabet as the 9th best stock to buy right now.
Right.
But let's address the massive bear case that's hung over Google for like 2 years now.
The cannibalization fear.
Yes. The fear that generative AI would cannibalize traditional search. Like, why click 10 blue links in view ads if Gemini just hands you the perfect answer?
That was the dominant fear, absolutely. But the data from Alphabet's Gemini ecosystem actively disproves that thesis.
Okay, how?
Well, Gemini has scaled to over 750 million monthly active users.
Wow.
And to handle that, the back-end infrastructure is processing over 10 billion tokens per minute.
10 billion tokens a minute. Just to clarify for everyone, a token is essentially a fragment of a word that the AI processes. So processing that many means their servers are running at a mind-bending scale.
It is massive compute overhead.
Right.
But the monetization strategy is what really matters here. AI queries from users are, on average, 3 times longer and significantly more detailed than traditional keyword searches.
Oh, that makes sense. You don't just type shoes. You type find me running shoes for flat feet under $100.
Exactly. And because the user's prompt is longer and more complex, Google's algorithms can parse the exact commercial intent with vastly greater precision.
Oh, wow.
Right. So everyone thought AI was the monster coming to eat Google search.
Instead, Google just threw a saddle on the monster and is charging advertisers a premium for the ride.
That is exactly what they're doing. They are currently testing ads directly inside these AI-generated answers. And the early data proves that engagement rates hold up just as well as traditional search ads.
Fascinating.
Crucially, because the intent is so clearly defined by those long prompts, Google can serve higher quality, significantly higher priced ads. This is proving especially lucrative in high-value categories like shopping, travel, and finance.
So they aren't losing the ad revenue at all?
No, they are upgrading it.
Upgrading it? Wow. Okay, let's pull all these threads together and deliver the final verdict for you listening. We opened this deep dive by asking a fundamental question about the April 2026 market bleed.
Yes, we did.
Are we witnessing the bursting of an AI bubble, or is this just the severe macroeconomic reaction?
And when you look across the entire technology stack, from the cold storage up to the search algorithms, the verdict is incredibly clear.
What's the verdict?
What we are experiencing is a severe technical correction fueled entirely by exogenous macro headwinds.
The macro pothole.
Exactly. The energy shock in the Strait of Hormuz and the leadership vacuum at the Federal Reserve, they are driving liquidity panic. This is not a fundamental collapse of AI value.
The numbers just don't support a collapse.
Not at all. I mean, when you see Microsoft and Apple expanding real revenues by 16 to 17%, when Google has a $240 billion cloud backlog locked in, And when Seagate can ration hard drives until 2029 because demand is so insatiable, the data proves the AI supercycle is fully intact.
So it's the pothole, not the engine.
Yeah.
The car took a massive cosmetic hit from the macroeconomic environment, but the internal mechanics are firing harder and more efficiently than ever. The underlying fundamentals haven't changed a bit, only the price tags have.
Exactly. The panic trap creates the discount,
Yeah.
but the fundamental data confirms the value.
Absolutely. Well, before we wrap up, all this data brings up a really provocative thought for you to ponder. We spent this time talking about physical bottlenecks,
Right.
how Seagate literally refuses to make hard drives fast enough, how Ford had to pivot an entire automotive plant just to build enough battery storage to keep data centers from crashing the local power grids.
Yeah.
As physical hardware, land, and power generation get pushed to their absolute maximum limits, will the ultimate ceiling for the AI supercycle not be a failure of software or algorithms, but simply the physical land and grid capacity available on planet Earth?
I mean, it really is the ultimate limiting factor.
Yeah.
We treat the digital revolution like it exists in the ether, but it is entirely irreversibly dependent on physical real estate and physics.
That's the data for today. Now, I want to hear from you. Are we looking at a temporary shakeout in AI or a fundamental structural break? Drop your bull or bear case in the comments below. Don't forget to subscribe to Balance of Economy for high-density market insights. Stay sharp and stay informed.